What's up, apes? Welcome back to the 𝗙𝗚𝗡𝗄𝗆 daily podcast of the day. Thank you all for joining us here once again on this beautiful Wednesday, August 14th, 2024. We got a lot to talk about here today. It was a huge session in the market. We got the latest inflation report, talking consumer inflation this time instead of wholesale inflation like yesterday. We'll go over exactly what that means for your portfolio, your macro outlook, your money in general, what you should be worried about, what you can disregard. Then we're going to be moving into some of the biggest stock moves of the session. Some very surprising moves here today, especially from the likes of Starbucks, a big divergence from their huge update the day prior. Then we'll finish up with a new alternative outcome in the recently settled legal case against Google, in case you're living under a rock and have no idea what was going on. Basically, a couple years ago, 38 state AGs, as well as the Department of Justice, filed charges against Google for being a monopoly. Well, a couple of weeks ago, a federal judge said, fuck yes, Google is a monopoly. He said the obvious truth that literally every human on earth knows. And so one of those outcomes is a potential breakup of Google. So we'll talk about what that might look like, what it would take to actually get there, how long it would take, historical comparisons as well. But before we get into all of that stuff, we got some important information to go over here. So we're going to start by going over the kind of market vitals of the day. Not a bad day for the WSO Alpha portfolio, but also definitely not a good one. We were down about 5 basis points for the session today, mostly because of Tesla. Tesla was a big detractor for the S&P 500 and the NASDAQ, and most of all, the WSO Alpha portfolio yesterday. The stock was down a little bit over 3% last I checked, but I think it actually finished down about 1.1% for the session. So that weighted us down pretty heavily because we are extremely overweight Tesla compared to these indices. Meanwhile, at the same time, the S&P 500 was up 38 basis points and the NASDAQ just a measly little 3 basis points. A rough day for tech stocks out there. We're kind of like a levered NASDAQ small cap portfolio almost. It's very strange, but we expect the Alpha portfolio to basically be that kind of rock in the middle. Like when the markets are up, we're going to be up but a little bit less. When markets are down, we're going to be down but a little bit less for the most part. So make sure to go subscribe if you want to get all of the juicy, gory details and make money, lose money, bully us right alongside of ourselves. Okay, let's go ahead and get into some of the big banana bits for the session here today, aka the stories that we thought were important, but I didn't care enough about to write about here today. Now, this first one very much relates to the inflation news that we got here on Wednesday. And that is that Fed funds futures markets. They are pricing for a bottom in rates at about 3%. That is much lower than what the Federal Reserve is currently looking for in the next 12 months or so, but that is what the market is saying, or at least the futures market is implying right now. So there's going to be a big divergence one way or another. Meanwhile, former Google CEO, Mr. Eric Schmidt, I thought when I saw the first part of this headline, he was going to be commenting on the DOJ ruling or the DOJ case and the federal judge ruling, but instead he came out and just completely exposed the firm, basically shared Google's nudes with the entire world, because what he did was come out and say that the company is way behind on artificial intelligence. Moving on down, the refinancing boom did not take long whatsoever to get started. We have seen a 35% increase in refinancing. We've also seen a 19% jump in mortgage applications over the last month or so. So all it took was a couple of basis points, just the thought that rates might even fall lower for people to start getting horny for new mortgages and new mortgage rates. So I can't even imagine what this is going to be like when they make an actual rate cut. It's going to be through the fucking roof. Once again, you're welcome for finally buying my house so that the housing market can heal itself. And keep in mind, we will be getting into, speaking of juicy, gory details, I'm going to talk about all of the horrific nightmares and lost sleep that I was given from the home buying process in a couple of weeks. But I want to make sure that I'm sitting in that house beforehand so that my, the loan company, whatever the fuck, the banks or anything can't completely fuck me over. Not that they're watching this, but, just in case, you want to be a little bit smart going forward. In a very, being smart going forward is going to be quite the divergence from my historical past. But, it's always good to try new things once in a while. Meanwhile, U.S. small businesses, I can't even explain why this would be possible, but small business optimism is at its highest that it's been in the past 2 years. Now, I don't know about you guys, but usually small business owners don't get too excited heading into a recession. So this is some good contrarian data basically saying that CEOs, founders of small businesses, again, the actual companies that do work in the economy, these guys are feeling pretty good going forward. So maybe we should be feeling all right too. Finally, mega cap tech stocks. They are the popular girl in school once again. Every investor wants to get a piece of them, getting more attention than they've gotten in the past 2 decades over the past couple of weeks. Investors completely pouring into mega cap tech stocks. Now, my view is that this is almost definitely a safety play, basically saying like, hey, don't know if we're going into a recession or not. Either way, people are still going to be buying iPhones. Let's go ahead and buy Apple shares. Now, with that same sentiment, our latest equity research report from WSO Alpha is going to be very much trading on a similar idea. So we're going with one of those stalwart companies. It's actually going to be on Philip Morris, yes, the company that I'm sure way too many of you out there like and enjoy their products way too much. I am certainly one of them as well. Mom and Dad, please look away from the camera. But of course, we have the Zins on us right now. I'm actually becoming a bigger and bigger fan of this stuff as well. These are called Lucy's. I don't like this flavor. I don't like the cinnamon shit, but Lucy's are pretty sweet too. Sponsor us if you want to as well, so that we can make some actual fucking money over here and maybe give you guys some discount codes as well. If anybody from Zin, Lucy, any cool companies like that, give the Daily Peel podcast a quick sponsor there. Okay, let's just go ahead and get into the macro monkey story of the day before I start begging for money from the audience as well. We are talking about today going from CPI to FBI, and it's a very clear reason why. Starting off with a question here, has a Federal Reserve chair ever been arrested? So it took about 248 years of beautiful, amazing American history back when history actually started in 1776. Since then, only one time has a former president become a convicted felon, and it was earlier this year. So it took us 248 years for a president to become a convicted felon. The Federal Reserve, founded in 1913, has only been around for about 111 years. So it's going to be a much shorter time frame because it's time that we press charges against Jerome Powell. And the specific charge we're going with today is assault with intent to murder, because the only way that I can explain the latest inflation report and ongoing inflationary trends in the U.S. economy right now is with this beautifully made meme right here. You probably can't see this, but this is the meme that's "Stop, he's already dead" from The Simpsons, and it's the Fed beating the shit out of inflation. This is domestic violence, it's economic violence, it's terrorism, it's violence, horrific shit of any kind, because inflation is getting beat to an absolute pulp, and that's what we learned in the CPI report yesterday. This is what the chart looked like, and this is our kind of modification of it, because what you're seeing here is the lowest inflation rate that the U.S. economy has seen since March of 2021. Almost 3.5 years ago, basically 3 years and 4 months ago was the last time that we had year-over-year inflation come in this low. Specifically, in July, consumer prices increased by 0.2% on a monthly basis, and drumroll please, 2.9% on an annual basis. It's the first below 3 reading, once again, since March of 2021. So what we're showing here is the path of inflation since March 2021. Back then, we were at a cute little 2.6%. People were starting to get a little bit worried that inflation was going to be a problem. But then by about, summer of 2022, I think it was July, April, June, July, August of 2022, we hit that brutal 8.9% year-over-year inflation. Then last month, we came right back down to 2.9%. So looking very good for the fellas in the FOMC. Definitely a good job. But again, kind of taking it a little far with this absolute beatdown that they're giving to the U.S. economy. So if we go ahead and look at it on a monthly basis, this is what we're seeing right here. So I can understand why some of you might be a little bit concerned by this uptick in inflation. So to give you the play-by-play, basically in May, we saw 0.0% increase. In June, we declined 0.1% on a monthly basis. And then in July, we were back up to a 0.2% increase. Now, this is actually a good thing, at least from my perspective, because when you're moving into deflationary territory, when you get a month-over-month print that is negative in terms of inflation, what that kind of signals is that maybe the Federal Reserve has gone too far. Now, maybe tightening standards have been, led to run for too long. Maybe we've tightened by too much. Who knows what it could possibly be, but it's an indication that the Fed has gone too far in some way or another. So seeing the monthly inflation print bounce back up to 0.2%, a very healthy level for any economic environment. Annualized, I think to get 2% inflation, we need monthly prints of like 0.16%. So this is right in that neighborhood. You want a bunch of 0.1s and 0.2s for any given year. This is getting us right back into healthy territory, and it's back on trend for what we were seeing earlier this year. So a very good sign. But at the same time, there is a little bit of a cause for concern when you break down these numbers a little bit more. If we go ahead and take a look at what was driving this monthly inflation print the most, housing. It's always housing. It's shelter costs that are doing the absolute most. Shelter costs contributed to 90% of this monthly increase. So without shelter, we basically would have been at 0.0%, or at least, far less than the 0.2% reading that we're at right now. Because, see again, 90% of July's inflation was triggered by shelter costs. Now, shelter costs, the way that the FOMC measures it is literally how a fucking baby infant child would do so too. They literally are calling landline phones. I talk about this all the time, but we're talking about it every single chance that there's a CPI report. until they make a change, because this is fucking absurd. Basically, what the Fed does is they call landline phones around the country and say, hey, how much do you think you could rent your house for? And so unless we think our grandparents are fucking savants for the housing market, do not pay attention to this whatsoever. Now, the tough part is you kind of have to pay attention to it because shelter costs make up about 36% of the CPI report, or at least they did in July. It varies in any given month from like 33 to 37% or so. Last month, it was at 36.3%. And within shelter costs itself, owner's equivalent rent made up 73.7%. Owner's equivalent rent is that process where they're calling people and saying, hey, what could you rent your house for? And we got to rely on grandma and grandpa to let me know what stocks I should sell, if I should run to my bunker, what the inflation print is going to be that month. Again, 90% of this increase is from shelter costs alone. Plus, we know that shelter costs from the actual pricing, like from even like the Redfin housing index, which is the most up-to-date one. It's only on a 2-month delay compared to the 3-month delay that you get for S&P Case-Shiller. We know that housing prices move at a lag anyway. So don't read too much into this. Basically, if anything, the monthly inflation report is overstated. Now, moving on down to the annual side of things. What we're seeing, once again, is a 2.9% annual increase. Now, if we go ahead and take a look at core inflation, this is stripping up food and energy costs, we're actually at 3.2%. That's not necessarily a bad thing because energy prices have been leading the way lower. Absolute shout out to energy prices for leading the way lower. What we're seeing right here is, once again, the lowest core inflation print that we've seen since April of 2021 at 3.2%. So once again, really no cause for concern. We're at the lowest point that we've been in the past 3 years. By the way, that's super core inflation. That's if we strip out energy, food, and shelter costs, we're at a beautiful 0.0% for the month and 1.7% for the year. That's, if anything, the Federal Reserve barely cares about the CPI report. They're focused on PCE. But if they care about anything within CPI, it's core and super core. So seeing 3.2% on the core side and 1.7% for super core, that's got to give them confidence that we're headed back in the right direction. And most of all, it is giving them the absolute green light to go ahead and cut rates. So what you're seeing right here is the change up in the market's thought process when it comes to the interest rate scenario for the Federal Reserve September meeting. Remember, as we talked about yesterday, we were at about 54% chance for a 50 basis point cut and, the remainder, 46% or so, for a 25 basis point cut. The script has been flipped today. After that inflation print, we now see a 37.5% chance for a 50 basis point cut at the September meeting and a 62.5% chance for a 25 basis point cut at the September meeting. Now, this is the reason that markets didn't completely pop off. It wasn't, champagne and cocaine for the day, as the cool kids like to say. It wasn't champagne and cocaine for the day because basically, what this inflation report told us is that the Fed is still doing its job. Everything is going well. Inflation is still very much on a trajectory lower. If it ain't broke, don't fix it. Keep in mind, Jerome Powell's biggest fear is being Arthur Burns. Now, Arthur Burns was the Federal Reserve Chair during the Nixon administration. Basically, what happened was he was getting a lot of political pressure from Nixon to keep rates low when he shouldn't have. That caused a re-trigger in inflation, and then Volcker had to come in, raise rates up to nearly 20% in order to save the day. JPow idolizes Paul Volcker. We knew that when he came into the Fed chair position. He's written papers idolizing the guy. I think he would. Never mind, I'm not even going to go there on this podcast, but I think you can imply what I'm thinking about right there. So, overall, green light for the Federal Reserve to start cutting rates. We are looking very good heading into the fall here. A lot of people are getting nervous once again that the U.S. economy is slowing, but really what's going on is a normalization process. Now, that doesn't mean that we couldn't start to actually slow and come into a recession in the coming months, but if you're looking for that evidence in the inflation report, you are not going to find it. Let's go ahead and move on to some of our big stock movers of the day. Actually, remember to change the chart this time, and you will see why in just a quick second, because Kellanova, this is it's a snack company. It used to be part of Kellogg, so think Pop-Tarts, think fucking Rice Krispie treats, think Cheez-Its, think Pringles, all that kind of shit is what Kellanova makes. So Kellanova, roughly about a year or so ago, at some point in 2023, Kellogg decided to split its business into two, with cereal on one side and the snack business on the other. Well, Kellanova is a hot commodity. They were not staying single for very long. Kind of like an attractive recent graduate in New York City. You are not staying single for very long at all, and neither is Kellanova. The stock was up 7.8% for the session here today because they are getting acquired by the fourth largest private company in the United States, being Mars Corporation. Mars, as many of you probably know, they make a whole ton of snacks like M&Ms and a bunch of shit like that. Apparently they do pet insurance as well. I saw that on their website today, which is super fucking weird. But maybe I misread something, but still, that's what's going on right now. Mars is paying approximately $35.9 billion for Kellanova, aka $83.50 per share. That is approximately a 33% premium to Kellanova's closing price prior to these acquisition rumors emerging. Now, these rumors have been in existence for basically 2 weeks now, so the stock's kind of appreciated in that time period. But if we go back to the date before these rumors started swirling around Wall Street, this would be roughly a 33% premium. So again, roughly about $36 billion. This is the second largest deal of 2024 so far, besides ExxonMobil and their like $65 billion acquisition of a competitor as well. I believe it's Pioneer Natural Resources. Like I said, Kellanova is not staying single for very long, and we can see why on this chart right here. So what you're seeing is a Reuters graphic of packaged food firms' share of the U.S. snack market in 2023. Basically, what they're saying is PepsiCo absolutely dominates at 9.06%. Number 2 is Hershey. Then number 3 position, we have Mars. Mars makes up about 4.54% of the total snack market in the United States. Meanwhile, Kellanova is at 3.92%. So now that these two are combined, Hershey is going to be moved down to number 3. These guys are going to get up to the number 2 spot. And PepsiCo, with their Frito-Lays and all the other snacks that they sling, they're going to still remain in the number 1 spot. Very interesting acquisition. Mars is essentially doubling down on the branded snack market going forward. And for a nation that loves sweet treats and has Ozempic prescriptions, I can understand why they are willing to do so. Moving on into our next stock mover of the day, we have UBS Group AG. The stock is up 5.6% for the day after a hell of a Q2. This company has done really well since a former financial advisor, former employee turned newsletter writer / video podcaster here left the firm. I don't know what his name was, but ever since they ditched that guy, the stock has been on an absolute tear, up about 40% since that point. So you're welcome to all of those shareholders. But essentially for me, this is like seeing my ex marry a billionaire or something, just knowing that they're doing a whole lot better without me, as most of them do. But the firm, UBS, that's what we're talking about today, performed particularly strong for the session. They nearly tripled bottom line expectations. Markets were pricing for about $18 per share, or about $12 per share, and the company came in and reported 34 cents per share in earnings on $11.9 billion in revenue. That revenue beat was about 4.2%. Very strong performance in the markets business, but that certainly wasn't even the star of the report. The investment banking unit at UBS absolutely killed it, up 55% for the year. So clearly, this merger with Credit Suisse is going pretty well too. If you need further evidence that it's going well, especially on the global wealth management side of things, they also increased assets by about $27 billion for the quarter. All is well in Switzerland on the banking side. Okay, moving on down into our What's Rotten moves of the day. First and foremost, we have Brinker International. This was an absolute tragedy because this is confirmation that, less and less Americans going forward are going to be hearing the 3 most important words in the English language. And that, of course, is welcome to Chili's, baby. Brinker International. This is the owner of Chili's Restaurant, Bar, and Grill, as well as Maggiano's Little Italy. 2 restaurants that I frequent way too much. I wish Chili's had as sweet of a deal as ~Dollaritas over at Applebee's, but they got the cookie skillet at Chili's. So how can you not muck that up? And they also have the 3 for me deal, which is, cheaper than going to fucking McDonald's these days. And that is actually exactly what the problem is right now. So, The companies, basically Chili's as well as Maggiano's, there was no trouble getting customers in the door, particularly on the chili side of things. They saw foot traffic increase 14.8% over the last quarter. They also saw menu prices increase as well. So more people plus higher prices. Same thing at Maggiano's, only it was a little bit less. They saw a 2.5% increase in foot traffic at Maggiano's. And again, price increases. But they haven't been able to manage their costs too well, and at the exact same time, a lot of customers are taking advantage of these very, very sweet deals, especially during this economic time period. So the company basically said, yeah, we didn't do a great job managing costs. Operational expenses increased 12% for the year, roughly on par with revenue. So the stock sold off, triggering basically on low expectations going forward and a potential hit to margins within the next fiscal year or so. So very bad day for Brinker International, down 10.7% on the session. Go to your local Chili's and bless them with your presence. Please do it for the sake of America. Finally, we have Starbucks down 2.1% for the session. The stock was down as far as 5% earlier in the day, and unfortunately for me, it didn't stay down that much. It didn't stay that far down for the rest of the day, but fuck it, I had already wrote about it, so we're keeping it in here. Basically, after the glimmer of hope that the stock received on Tuesday, it was up about 24% for the session yesterday. Investors started to pull back a little bit. Reality set in. They were over the fairy tale of getting the wonderful CEO who's going to turn everything around and right the ship and make fucking invent the next pumpkin spice latte or whatever the fuck is going to increase sales over there. Basically, there was two big things that brought the stock down a little bit lower here today. First and foremost, for his very hard work in shedding $32 billion in company value during his tenure, the former CEO of Starbucks, I'm not even going to try to pronounce his name, he is receiving a fat pay package of about $10.6 million. So investors are a little bit upset that we're giving $10.6 million to this guy who's already eviscerated $32 billion from our wallet. At the same time, interim CEO, I don't know if her brain wasn't turned on when this was going on, why the fuck you would do this while you're the interim CEO on the first day of being the interim CEO. But she took advantage of the share pop on Tuesday and went ahead and dumped $320,000 worth of Starbucks stock, once again taking advantage of that pop. Yeah, so basically they saw a lot of insider selling, and they're giving the former CEO who lost them a ton of money even more money. So I can understand why investors were a little bit upset for this session. Okay, moving on down into our final story of the day. We are talking about dismembering the alphabet. I would have said murder the alphabet, but Eminem already did that in his 1999 banger. Still don't give a fuck. He can't rap anymore because he just murdered the alphabet. Well, the DOJ wants to do the exact same thing. Rumors have been swirling that the Department of Justice is going to seek as a remedy for Google being a monopoly for the company to be broken up. Now, let's back up here. That is a very, very rare occurrence in the United States. It's basically only happened 5 more times, and that was with Standard Oil, it was with the American Tobacco Company, it was with Alcoa, AT&T in the 𝗪𝗏𝗪 case, and then Microsoft in 2000. Microsoft didn't end up having to actually break up the company. They just got a whole lot of restrictions put on them. But still, those are the only 5 times in American history that a company has been ordered to break up. Google could be number 6. Lucky number 6 for this company. However, it is still a very unlikely situation as it currently stands. So Wedbush analysts were really the only ones commenting on it for the day. Basically, they said that it would be a stretch if the DOJ sought that as the only remedy. So they don't really expect it necessarily, but either way, the minimum amount of time that any one of these breakup cases took to work through the court system was 7 years. So I don't know about you guys, but I don't think the court system or the U.S. government has actually sped up since 2000. So, expect to have an answer on this by about 2031 or so. Make sure to set your watch so that you don't forget. But nonetheless, that's what's going on right now. Now, if we take a look at breakups in history, and specifically the AT&T breakup, aka 𝗪𝗏𝗪. If you don't know, AT&T in the 1970s and 80s basically owned every telephone operator in the United States. Every kind of telecommunication system was AT&T. So the Department of Justice basically ordered that they break up into 8 separate companies. There was one long distance phone call company, so you could still call from New York to Los Angeles, but all the other ones were much smaller regional companies. They were called baby bells for whatever the fuck reason. But nonetheless, after the breakup, this is what we got right here. So this is a chart from Scott Galloway and his blog. Basically, what we're looking at here is the number of patents in a given industry after a company or after the monopoly within that industry was broken up. What you're seeing is a huge increase in the rate of patents compared to other industries. So following a breakup, innovation returns and so does shareholder value. I was looking so much of the day for a chart that would actually reflect the average shareholder value increase after these breakups. Now, it's a very small sample size, so I would think that it would be relatively easy to compile, but I spent way too much time in the emergency room today that I didn't have, exactly enough time or wanted to waste that time going through it. Also, don't worry, everything is totally fine as well. It's just a bit of a scare for us. But nonetheless, things look better for an industry, for shareholders of that company when a breakup occurs. I know it's kind of counterintuitive, but nonetheless, that is what history shows. So let's go ahead and speculate wildly on what an Alphabet breakup might look like. So what you're seeing right here is the latest that I could find on Alphabet's corporate structure. The way that it works is that all of these top companies right here, these are their loss makers, essentially. This is the Google, quote unquote, other bet side of the business, which is basically all Google Ventures. Even though Google Ventures is actually part of the other bet side of the business, basically this is a venture capital portfolio or like a private equity holding company, essentially, for all of these different companies. That's the other bet side of the business. And then what you have is the Google search business. You have Google Cloud, YouTube, Android, hardware, and digital infrastructure. So that is Google laying naked on the table right there. That is what you're seeing in this image. And I'm sorry to Jason Tatum for moving his bobblehead out of the way. Nonetheless, this is my wild speculation on what a Google breakup might look like. So personally, I think it would be done in 5 parts. First and foremost is going to be Google Search. Google Search will be allowed to remain a standalone company. And they're only going to do so with certain restrictions that are going to require Google to share data with competitors to kind of even the playing field a little bit. But Google Search will remain its own standalone company. Now, there will be a new second largest search engine in the entire world as a standalone company as well, being YouTube, because right now the two largest search companies in the world, or at least in the Western world, I don't know how big, how Baidu stacks up compared to some of these other competitors. But nonetheless, Google Search is number one, YouTube is number two in the Western world. These are going to be standalone companies if this breakup does actually occur. The third company that's going to be standalone after this is going to be Google Cloud. GCP will be standing on its own 2 feet going forward. This is a company, besides search, it's one of the highest margin businesses at Google. This would probably be the one that would increase the most over the long term. It would be the same at Amazon if you broke up retail and AWS, for example. So Google Cloud, very easy to spot and kind of slice and dice and say, this should be its own company. Then I think you're going to combine all of these into one company right here. You have Android, hardware, and digital infrastructure. These all kind of go one and one. All their hardware devices run on Android systems to a certain extent. Then the digital infrastructure just kind of fits into there nicely, mostly because I don't really know what they do in that side of the business. Finally, the other company is going to be all of these ones at the top as one quote unquote other bets. This is just going to become a venture capital portfolio PE holdco. Imagine they spin it out and then open a fundraising round where LPs can basically invest in all of these different companies. Who wouldn't want a piece of DeepMind, Waymo, whatever the fuck Access and Energy is, or Calico too? Like, these are huge healthcare opportunities, transportation opportunities, all of these. If everything went well, these could be, deca-billion-dollar businesses, maybe even trillion-dollar businesses on their own at some point. So that's my wild speculation on what would happen if Google was to break up. Let us know what yours is as well. Let us know if you have any wild thoughts that you want to share. Shoot us an email too. Guys, let us know your thoughts. Give us your reviews. I know these are way too long as well. I promise you, I'm trying to stop yapping so much. This has been 26 minutes already. Send me an email, david@wallstreetoasis.com, if you have any thoughts, if you have any questions that you want us to answer, or anything that we can share on the podcast. We want to make this more interactive, so please let us know. Thoughtful emails get thoughtful, felt out responses, and we'll be happy to go ahead and cover that all in the next edition. But for now, that about does it for the day today. Thank you guys for tuning back in once again. It is now 7:38 p.m. on this beautiful Wednesday, and I'm going to go ahead and probably go to sleep, to be honest with you. So happy investing, happy trading, have a great rest of your day, and bye now.